All right, so the next few slides will be some illustrations on the second half of the homework in My Accounting Lab. All right, so this is number 6 on your homework. And so in this problem, you're going to be dealing with the concept of residual income. I went ahead and clicked on the icon, which is, here's your data table right here. You've got snow sports and non-snow sports, and as you can see, they give you the sales, they give you operating income, total assets, current liabilities, and they already calculated the ROI for you. Here's the other thing that's important in this problem. It says Extremes Management has specified a target of 17% rate of return. That's their target rate of return. So to calculate residual income, you simply take the operating income and subtract out the target income. And so the way you calculate that, over here is a solution for snow. What you do is for snow, you take the total assets, both of them individually, and you're going to multiply both of these by 17%. And that's what they're essentially showing you right over here. So for snow, if you took 4.2 million times 17%, subtract that from the operating income, you get $258,000. That's called residual income. You do the same thing for non-snow, 6,400,000 times 17%. Subtract that from the operating income, you're going to get a residual income of $406,000. Note that the non-snow is more than the snow activities, which is also consistent if you go back on the ROI calculation. The non-snow sports had a higher ROI. So when you look down here where it says interpret the results, you'd want to be putting in, they both have positive residual income, and that means that the earning income rate exceeds their expectations. And the question says, are your results consistent with each division's ROI? And the answer is, of course, yes, they are. The non-snow sport has a better residual income and a better ROI. All right, so this is problem 7 on your chapter 10 homework, and I'm going to try to explain this particular problem over the next 3 slides, this being the first slide. And so on this problem, I clicked on the data table, which they give you actual results, a flexible budget column, and also a master budget column. And of course, they want you to fill in all the blanks. That'll be at the end. And so in this problem, you can see you've got questions 1, 2, and 3. 4 will be on the next slide. It says, how many pools did Surfside originally think they would install in April? And of course, if you just go back and you look at the master budget, that was the plan. The answer is 4. Question 2 says, how many pools did Surfside actually install in April? Well, if you go to the actual column, of course, the answer there would be 5. So they had budgeted 4, they actually installed 5. And so the question says, how many pools is the flexible budget based on? And remember that the flexible budget will always use the actual results. So the number over here, when you plug that in, you're going to use 5, not 4. This basically gives you an apple-to-apple comparison. So you can compare actual results using both the volume, and the budgeted aspect is going to be into the sales revenue and the variable expenses. These numbers right here are going to be the budget based on actual. So it kind of tells you, the flexible budget essentially tells you this is what you think should have happened based on actual results. And of course, you can look at these numbers as well. So I'll go to the next slide and we'll kind of keep going with this problem. All right, so using the data, again, remember we had just answered number 3. So on number 4, the question says, what would be the budgeted sales price per pool? And of course, they give you this number right here. And you might say, well, how do you get that? Well, all you do is you take the 88,800 and divide that by 4. So you get the $22,200. So 88,800 divided by 4 would be your budgeted sales price. Number 5 says, what was the budgeted variable cost per pool? Very simple. You'd take this 48,000, that's your total variable cost, and again, divide by 4. So everything you're dividing by 4, that would give you the 12,000. Number 6 says define the flexible budget variance, what causes it, and you're going to have to fill in the blanks. As the name suggests, the flexible budget variance is the difference between the flexible budget and the actual results. And of course, everything else, any differences between flexible budget and master budget is based on volume. So you'll see that in this little link right there. Number 7 says, define the volume variance. What causes it? Well, what causes the volume variance is because the flexible budget is, in this problem, is going to be using 5 pools, whereas the master budget uses 4. So any differences between the flexible budget and the master budget is because they use a different volume. All right, so here's going to be the solution to these variances. You'll notice they gave you've got the actual column which was given. The only thing they didn't give you in the question mark is you simply have to add up, for the actual column, you have to add up all your expenses, $56,000 and $27,000. So over here, that's where they would have come up with the $83,000. And then of course, on your flexible budget, you're going to be using 5 as your volume. That's where they got that volume. They've already given you these. So then you simply just have to add these together. So that's where they'd get, of course, the 91,000, which you're going to see right there. And then all you're doing here is you're just comparing the 2 columns. Obviously, that's 0. The flexible budget, the volume is the same. The difference between sales revenue, the flexible budget said 111,000, actuals 105. That's a $6,000 unfavorable variance because you had expected you'd have more revenue based on the actual results. So the difference is 6, and of course you'd say unfavorable because you want the actual revenue to be more than the budget. Then when you go to the expenses, you're comparing 56,000 actual to 60. That's actually good. That's a 4,000 favorable, meaning that you did not incur as many expenses as you thought you would. And then the same thing with the fixed costs. You had 27,000 versus a budget of 31. That's also 4,000 favorable because you incurred less fixed cost. So overall, your operating expenses are good by 8,000, and your revenue was bad by 2. And if you netted the 2 together, you'd be a $2,000 positive variance because even though you had less revenue than you'd expected, you also incurred a lot less cost. Everything else then you can be comparing on your volume variances. Notice here there's a volume difference of 1, and then you're just comparing the flexible budget to the master budget. Notice the differences is 22,200. You had more revenue, so you said favorable based on comparing flexible budget to the master, but again, that's not an apple-to-apple comparison because you're using different volumes. Same thing on the expenses. You got 60,000 versus 48. Of course, you'd say unfavorable because you, based on what you think is going to happen, is more than the budget. That's 12,000 unfavorable, but again, unfavorable because of that volume. And of course, they use the exact same fixed cost, so there's no difference there. Okay, so that's how you put it together. And then here's another flexible budget performance comparison. And again, notice you have actual, flexible, and of course the master budget. And I'm just going to highlight the top row. First of all, notice that the actual 13.2 is the same as the flexible. Notice also that the master budget uses the budgeted sales, not the actual. So actual, flexible budget use the exact same volume. And of course, if you just look at these differences, because this is what they wanted you to do, they gave you the amounts. So for the actual, here's how you want to read this. You incurred $338,200 in revenue. The flexible budget says you should have gotten $343,200, so that's unfavorable by 5. You had thought you should have gotten more revenue, so that's why that's unfavorable. Now on the expense side, the sales expense looks like for variable you incurred $24,500. That's less than the flexible budget by $1,900, so you're going to say favorable. That means you incurred less cost than you thought you should have. That's good. On the shipping, you incurred $65,500 versus $66,000. That's a $500 favorable variance. That's good. And then on your fixed cost, it looks like you incurred $12,200 versus $10,800. That's not so good. You incurred $1,400 more of salaries than you had expected. And then finally, the office rent was the same, nothing there. Overall, unfavorable for actual compared to flexible, and you can go back and study exactly what was causing that unfavorable variance. Everything else, when you compared flexible to master, notice again, flexible had more revenue than the master, so that's why that's favorable. And then everything else is really just based on the 2 volume differences. It's all volume driven. So the sales expense of $26,400 versus $24,000, you'd say unfavorable. because that's using actual numbers, but again, volume driven. Shipping costs 66 versus 60, that's bad. So again, they say unfavorable. And then down below salaries, you had 10.8 versus 10.8, and office rents, those are the same. So notice there's nothing there. All right, and this is question 9. And so on this one, you're going to be calculating sales margin, capital turnover, and return on investment. I clicked the icon, so all your data is over here. Notice they gave you operating income, total assets, current liabilities, sales, and of course the target rate of return of 15%. So the first thing is on sales margin, it's operating income divided by sales. So it's 7560 divided by 27,000 gives you 28%. That's your sales margin. Capital turnover is sales divided by total assets. So 27,000 divided by 12,000 is 2.25 times. And it says now enter the formula, then calculate ROI. So again, you can take you take the operating income, which is 7560 divided by your total assets of 12, gives you a 63% ROI. Requirement 2 says calculate the residual income. Well, of course, you know operating income, and of course the targeted assets of 12,000 times the target rate of return of 15%, subtract that from the operating income, you would get a residual income of 5,760.